What is involved in doing an IPO? Prospectus. While stock exchanges have varying rules for allowing a company to list shares and go public, they typically require a listing document or prospectus at the time of the IPO, and also have ongoing reporting, disclosure, and transparency requirements. So, before starting the process, companies need to review the key requirements. For example, 3 years of profitability, fully compliant board structure, good corporate governance, and so on. And even start planning years before an IPO itself. The IPO prospectus is a lengthy document that goes through at least 3 years of financial information in great detail, with auditors and banks doing extensive due diligence and then disclosure. The prospectus is designed to provide the public with detailed information about the company, much of which is not required for a private company. The prospectus is in a standard form required by the stock exchange and is reviewed in detail, often requiring many iterations to fully meet the listing requirements. Ongoing reporting. There is also an ongoing requirement for periodic financial reporting, major shareholder disclosure, and other information for public investors. In addition to discussing timely financial information, often on a quarterly basis, there is ongoing reporting of senior executive remuneration and incentives, as well as strong internal processes and controls to continue to generate the required information on a timely basis. Additional regulations. Listing also brings in rules on how to raise new capital going forward, partly to protect the broader public investor base, as well as rules around takeovers, share buybacks, and disclosure of significant transactions.